Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is September 26th, 2025, and we are diving deep into the SPDR S&P 500 ETF, ticker symbol SPY. The market is on edge after posting its third straight day of losses, pulling back from recent all-time highs, and we're here to break down what's happening and what to look for next. First, let's cover the news that's driving this market sentiment. Wall Street is grappling with a classic good news is bad news scenario. Stronger than expected economic data, including a sharp upgrade in second quarter GDP to 3.8% and an unexpected drop in jobless claims, is complicating the outlook for Federal Reserve interest rate cuts. The market has been pricing in aggressive rate cuts, but this robust data gives the Fed's more hawkish members reason to pause. In fact, we're hearing a split narrative from within the Fed itself, with some officials expressing discomfort with cuts while others advocate for them more rapidly. Adding to the uncertainty, we have fresh tariffs from the Trump administration and ongoing concerns about a potential government shutdown, which are weighing on investor sentiment. The big event everyone is waiting for is tomorrow's personal consumption expenditures, or PCE report, which is the Fed's preferred inflation gauge. This release will be a pivotal data point that could either fuel a market rebound or confirm the recent bearishness. Now, let's turn to the charts and see how this news is reflected in the price action. Looking at the daily chart for SPY, we can see the broader context is still a powerful uptrend that has been in place for over a year. After a significant pullback in early April, where we saw prices drop from around 611 down to the 480s, the market has carved out a steady path higher. Just this week, on September 22nd, we printed a new all-time high right around the $667 mark. However, the past three sessions have seen a decisive rejection from that peak. We've now pulled back to a closing price of $658.05. This three-day slide is significant because it's the longest losing streak since March and has occurred on relatively high volume, suggesting some conviction from sellers. The first key support level to watch is the low of yesterday's session, right around 654.40. This is the immediate line in the sand for the bulls. If we break below that, the next major support zone comes into play around the 645 level, which acted as a consolidation area in late August. Below that, we'd be looking at the August lows in the 630 to 635 range as a more significant support structure. On the upside, immediate resistance is now the bottom of the breakdown area, around 661 to 663. And of course, the ultimate resistance to reclaim is the all-time high at 667. Switching over to the 1-hour chart gives us a clearer picture of this recent downturn. You can clearly see the series of lower highs and lower lows that have formed over the last 3 days, which is the definition of a short-term downtrend. Notice the significant gap down at the open on September 25th, from a close near 661 the prior day to an open around 658. That gap represents a strong shift in sentiment and now acts as a formidable resistance zone. The price attempted to rally early in the session but failed decisively, reinforcing that sellers are currently in control on this time frame. Holding below the 660 level is a short-term bearish sign. Now, let's drill down even further to the 15-minute chart from yesterday, September 25th. This view shows the intraday story of the seller's dominance. After the initial gap down, there was a weak attempt to push higher that failed before 10 a.m. From there, the market bled lower for most of the day, finding a temporary bottom around 654.40 in the early afternoon. Although it managed to bounce slightly into the close, finishing the day near its lows is a weak posture and suggests potential for follow-through selling at today's open. The lack of any significant buying pressure throughout the session is a key takeaway from this microview. So, let's put it all together and consider the bullish and bearish arguments. The bullish case is that the long-term uptrend remains intact. This 3-day slide could simply be a healthy and needed pullback before the next leg higher. If tomorrow's PCE report comes in cooler than expected, it would reignite hopes for Fed rate cuts and could easily trigger a sharp reversal. A strong bounce from the 654 support level would be the first signal that bulls are stepping back in. Conversely, the bearish case is that the market is finally reacting to overstretched valuations and the reality that strong economic data makes imminent rate cuts less likely. The momentum is currently with the sellers, and the chart has printed a clear short-term reversal from the highs. A hot PCE number could be the catalyst that breaks the 654 support level decisively, opening the door for a deeper correction towards the 645 support zone. So let's recap the key levels and potential outcomes. Your key resistance levels to watch are 663 and the all-time high of 667. Your key support levels are the immediate low at 654, followed by the stronger support zones at 645 and then 635. Now for our unbiased predictions. The most likely scenario, which I'd place at a 50% probability, is continued choppy, range-bound action between 654 and 663 as the market digests the recent move and awaits the PCE data. A bullish breakout scenario, with about a 30% probability, would be triggered by a soft inflation number. Look for price to reclaim the 663 level on strong volume to confirm a move back towards the highs. A bearish breakdown scenario, which I'd assign a 20% probability, would likely follow a hot inflation report. A sustained break below 654 would confirm this, with 645 as the next logical target. The most important thing to watch is tomorrow morning's PCE data, as it will likely set the market's direction for the near term. Also, keep an eye on statements from Fed officials and any developments regarding the government shutdown. That's our analysis for today. If you found this helpful, please hit the like button, subscribe to Explain the Charts, and let us know your thoughts in the comments. Trade safe, and we'll see you next time.